to another market and economic update. I'm Jason Rericha with YellowWood Wealth Solutions, and today we'll be covering three big topics that are driving the markets right now: technology stocks, IPO activity, and what higher long-term interest rates could mean for investors. So the S&P 500 recently crossed 7,500 for the first time ever, which is great. At the same time, though, there remain some important factors investors need to be paying attention to, like inflation, rising oil prices, and higher long-term interest rates. Let's walk through each of these points, explain what's going on, and talk about what it could mean for your portfolio going forward. All right, first let's talk about technology stocks and the role they're continuing to play in the market rally. The Magnificent Seven, companies like Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla continue to lead the market higher. Together, these companies now make up roughly 35% of the S&P 500, which is a pretty significant concentration. And that's important for investors to keep in mind when looking at how diversified their portfolios really are. What's driving these gains isn't just excitement or sentiment. Many of these companies continue to deliver strong earnings growth. And in fact, overall corporate earnings across the entire S&P 500 have remained well above historical averages. Now, at the same time, stock prices have risen quite a bit and valuations have moved higher along with them. As of May 20th, 2026, the S&P 500 was trading at about 21 times forward earnings, compared to a long-term average of closer to 16. Technology stocks are even higher, at around 24 times forward earnings. Now, that doesn't necessarily mean stock markets are about to decline, but it does reinforce the importance of staying diversified and balanced, having a long-term investment approach across different sectors, geographies, and asset classes. Next, let's talk about IPOs, or initial public offerings, which are getting a lot of attention recently. There's been a lot of talk about major companies like SpaceX, Anthropic, and OpenAI potentially going public in the near future. These are companies that have already grown a lot while staying private, so if they do IPO, it would be the first time everyday investors have a chance to own the stock. Now, for long-term investors, it helps to keep this in perspective. Broad market indices naturally pick up new companies over time as they grow and become part of the public markets. So in a sense, you don't necessarily need to chase IPOs to benefit from them. It's also worth remembering that IPO activity tends to come in waves. When markets are strong and money's flowing, more companies tend to go public. We saw this during the dot-com era and most recently during the SPAC boom during the pandemic. History shows that IPO excitement doesn't always translate into quick gains for investors either. In fact, in many cases, early access is mostly limited to insiders or institutional investors before the broader public even gets a chance to own these stocks. Lastly, even though the stock market has continued to move higher, long-term interest rates have as well. The 30-year Treasury yield recently hit its highest level in nearly 20 years before retreating back closer to the 5% range. Mortgage rates followed that move, with the 30-year fixed mortgage now sitting around 6.5%, which is above its long-term average. These higher rates matter for a couple of reasons. They can make housing less affordable, increase borrowing costs for businesses, and also affect how investors value future earnings, especially for fast-growing companies. On the positive side, though, higher interest rates also mean bonds are finally offering meaningful income again after a long period of very low yields. For long-term investors, and especially retirees, that brings fixed income back into focus as an important part of a diversified portfolio, both for generating income and helping to manage overall risk. If you found this information helpful, please consider liking this video or subscribing to our channel. We greatly appreciate that. And if you'd like to talk about this further, we're happy to set up a time to answer any questions you have. Thanks for watching, and as always, healthy plan, wealthy life.